Emerging market bond investors must be feeling almost euphoric after the kind of performance we had in 2019. Returns were up over 12%, the best year since 2012. Unfortunately, a number of factors that contributed to the strong year in 2019, such as declining interest rates and cheap valuations, are no longer valid. Nonetheless, we are still reasonably constructive on emerging market bonds in 2020 for several reasons. In 2019, credit performed well despite geopolitical headline risks, the most damaging of which were the US-China trade dispute and fears of a hard Brexit. In 2020, a sluggish US economy, coupled with the upcoming US presidential election, is making a trade truce with China increasingly desirable. Additionally, a hard Brexit seems increasingly unlikely. From a top-down macro perspective, the outlook is improving. The IMF is expecting emerging market growth to improve to 4.6% in 2020, up from 3.9% in 2019. Globally, fiscal positions in emerging market countries remain generally sound with improved current account balances. A number of countries, including Brazil, Indonesia, Ukraine, and Egypt, are in the midst of implementing bold economic reform agendas. From a bottom-up perspective, defaults were below 2% this year, and with more than adequate company fundamentals, we anticipate further low levels of defaults in 2020. While valuations are not as compelling as a year ago, they're also not particularly rich on a multi-year basis, particularly versus developed market credit, and especially for our favored high-yield segment. Pulling this all together, we are projecting around a 4.5% to 4.75% total return for the asset class overall, with high yield returning 7 to 7.25% and investment grade 3.25% to 3.5%. From a geographic perspective, we are recommending an overweight in Asian high yield, which has the highest yield of any credit asset class globally. Within investment grade, we favor Latin America and the GCC. Latin America has a higher yield, but also a higher duration, which can be a good hedge against a long credit bet, while the GCC offers both incremental yield to Asia, but also strong government linkages and demonstrated local investor support.